Infinite banking, it is a way to build wealth quickly. What is it? How do you get started? We are going to give it to you in simple steps right after this. Hello and welcome to Real Estate Divas. Today we are going to be discussing infinite banking with our gorgeous guest, Erica Neal. And Erica, why don't you tell everybody what your qualifications are, what you do?
Yeah, absolutely. So like she said, my name is Erica Neal with Infinity Investment Strategies. I'm an authorized infinite banking practitioner. A little side note, I'm also a certified personal financial coach as well as a certified financial education instructor. So long story short, I teach people a lot of different stuff.
That is great.
About finance.
About finance specifically, yes.
Yeah.
Yes, finance.
So you're a good person to know. And infinite banking, really, it's this big thing. And every time I hear people talk about it,
Your eyes glaze over? It's
a
like,
little
what?
bit.
What are you talking about?
I understand the idea of it, but it's just too big for me to wrap my head around of why it works.
Yeah, and really infinite banking is nothing new. So a lot of people don't realize it's been around for a long, long time. In fact, it predates the IRS. So it's really just a strategy for people to warehouse their money, warehouse their wealth in a place outside of a traditional bank, right? So we're taking these specially designed cash value policies, and instead of focusing on the death benefit, because most people think life insurance, death benefit, well, you can take these policies and actually focus on the cash value or the equity of these policies and use that to store your wealth, hold cash. You can use it to invest. You can use it for a lot of different aspects. And really, it's just an alternative to leaving money in the bank where you're getting a negative return because of inflation.
So to be clear, like what you said, like a death benefit. So we are actually taught, when you say infinite banking, I think of it as a totally different thing. You're talking about it is an insurance policy, basically.
Yes, it is a permanent life insurance policy. Now, infinite banking, when you're looking at a real infinite banking policy, we're using dividend paying policies that come from companies that are mutually owned, and they're issuing whole life policies. So that is infinite banking in its purest form, in the way that it's supposed to be done. There's a lot of other, I guess, people who are slinging different products for different reasons that are not infinite banking focused. But when you're looking at it from that perspective of protecting cash, warehousing cash, borrowing against it, using those dividend paying whole life policies from mutual companies, it is a life insurance policy. The reason we're using those is they're an asset class all on their own. So you think about like a bank, your bank account is classified as an asset, right? Stocks and bonds, they're classified as an asset. Real estate is classified as an asset. Life insurance has its own IRS code, which means it has its own rules, it has its own tax benefits, it has its own protection pieces. So there are completely separate rules written for these types of accounts, and we're just going to take advantage of what's written.
So with regards to inflation, everybody is feeling it right now. You know, typically, historically, it's always been about 2% a year, but right now when we can feel inflation because it's 6% in weeks or months, and that's huge. How is infinite banking a hedge against inflation?
Oh, absolutely. So like I mentioned, these policies inside of a life insurance contract are going to be based off of whatever that life insurance company offers. So we're using whole life because of the guarantees that are built in. So when I say guarantees, most of these policies, the ones that we use, we only use top 5 A-rated companies. We're independent brokers, so we can use any policy we want, any company we want. We only go with the best. And a lot of times we pit them up against each other to say, hey, you know, if we want to use this company, well, this company over here gave them a really good health rating. Are you willing to compete? So we have that competitive advantage for our clients, but we're going to work with them because they have, a minimum 4 to 5% guaranteed interest rate with dividends on top of that. So and a lot of times if it's a 4% guarantee, they're going to have a higher dividend. If they have a higher guarantee, they'll get a lower dividend. There's no free money. It just depends on what you're looking for. But that's what helps hedge against the inflation is your liquidity can earn that every single year repeatedly and help offset what's going on outside of the account.
So you're parking money in this, in a way, kind of buying a stock. and it's paying you interest, or a checking account maybe that's paying you interest, but then it can also pay you dividends on top of that, whatever profits they make, right? Because they're taking your cash that you have parked with them and they are reinvesting it.
The same as a bank does, except the bank doesn't really pay you for that when it's in the checking or a savings account.
So yes, and there's an even bigger piece to the strategy with that exact mindset is what are banks doing with your money? You need to recreate that same system. So I want to come back to that.
Okay.
But as far as like how they're coming up with it, when you give your money to the insurance company, let's just say this. So we are buying a life insurance policy, and with that, everything has an acquisition cost, right? Like when I buy real estate, there's an acquisition cost. If I buy a mutual fund, I have to pay an upfront sales load or a back end. If I buy a stock, I have to pay a transaction fee. There is no free money, and anybody that tells you otherwise is probably trying to bait and switch, right?
Absolutely.
So with these companies, what they're going to do is, if you were to buy a policy, there's an upfront acquisition cost. Once you overcome the acquisition cost, which I'll get into in a minute, you have this guaranteed growth rate inside of it. But what they're doing is they're taking your money and they're going to look and say, oh, well, we have this person. Let's say it's a 45-year-old female. Well, they know, based off of all the actuarial science and all the mortality tables and all the crazy math these nerds in the closet have done, they know, well, this is how much money we need to bring in. This is how much in death benefit we're going to have to pay out this year statistically. And they're ridiculously accurate.
That's so crazy to me.
It is. It's scary, but it's, and like they're not going to know, oh, well, you're going to die, but they know how many 45-year-old women are going to die. Like, you know what I mean? Just based off of the statistics. So they know how much they're going to have to pay out. So they know what they need to bring in as premium wise. They also are doing their own internal investments. So what a lot of people don't realize is insurance companies increase their the amount that they're purchasing in real estate by like 30% last year. So they are going out and they're buying real estate, and they're doing laddered bonds and all of those different types of strategies. The thing about a insurance company we have to realize is they are immortal. So they don't have a 3 to 5 year exit plan. So they can hold it out and make it last forever. They buy these treasury bonds that are 5, 10, 20 years out. So they know exactly in 5, 10, 20 years how much is coming in. So they are not doing it based off of speculation. They're doing it all based off of actuarial science and statistics. So they know exactly what their costs are, how much is going out, so they know how much to charge to come in. So to your point, with their profits, that's just a distribution back to the shareholders. So when we're using these mutual companies, you cannot buy stock in them. Not me, nobody can buy stock in these guys, right? So if you were to buy, let's say from a company that's not mutual, if they get a dividend, who do you think they're going to share that dividend to? The shareholders, right? Well, if you buy a policy with a mutually owned company, they don't have shareholders. So who do they have to impress? Their policyholders. And in fact, they actually, as a mutually owned company, get incentivized by the government and tax benefits and all this by distributing those dividends and not keeping them. They don't want to keep them because then they're going to get taxed on them. They can distribute it to the policyholders. It goes into your policy, and guess what? You don't get taxed on it either.
Oh, wow. Even if you take it out.
Now, there's a couple of strategies on that.
Okay.
So if we want to go into
we'll get to that in just a second.
There's a lot of tax benefits. And
Gotcha.
again, and we were talking about this, Kristen, like this has to be done correctly. There's no such thing as a good tool. There's no such thing as a bad tool, right? Like sometimes I say whole life, I'm like, oh my God, like I was told whole life is bad. Compared to what?
Yeah.
Like,
Like, what are we doing here?
yeah,
Right,
is a hammer a good tool or is a hammer a bad tool?
Yeah.
Okay.
What are you using it for?
Yeah, am I trying to, do I need a screwdriver instead of a hammer?
Exactly. And that's, when I'm not telling people, oh, put all your money into a infinite banking account and that's going to be the only thing you ever do. No, you need to just warehouse your wealth there, hold it there so that when you have an opportunity to take the cash out and go invest in, a business or buy a house or buy real estate, Bitcoin, you can go on vacation. My business partner used it to put windows in his house. I've used it for a down payment on, you can use it for whatever you want. The point is you use that money to go out and invest. Whatever you invest in is your rate of return and your accumulation tool, not your infinite banking policy.
Yep.
That's
Right.
just a warehouse.
Yep.
So when you are loaning money to yourself doing that, are you still getting interest from the insurance company?
Perfect question. And that partners exactly with what you asked earlier. So let's say, Kristen, you come to me and I'm your banker, right? You deposit money with me and I might pay you, 0.02%? right? But then JER'LEIGH, you come in to get a loan, okay? And I'm going to loan it to you at 6%, okay?
Right.
But I'm a bank. I don't have any money. So whose money do I loan you?
You're loaning
I'm
me
loaning you
Kristen.
Kristen's, right?
Yeah.
So what I did was I'm paying Kristen 0.02% so I can make 6% off of you. Well, to the naked eye, we're all taught to think mathematically and think linearly. So we look at paying 0.02 and earning 6. Well, they're making 5.98, right? Nope. That is not how it works. That is looking mathematically. You have to think through the lens of money. So let's think about this differently. If you buy whatever for 0.02 for 2 pennies, right? At the end of the year, if that stock or if that asset, whatever it is now worth $6 in 1 year, that's a 300x return. So that's what banks are doing, right? They're getting a 300x return by paying you a little bit and earning a lot, right?
Yep.
To your question, what you do is, let's say that I've got $200,000 in my cash value and I want to put $100,000 into a deal, right? I can borrow against my policy for that $100,000. I'm going to go invest it, get whatever rate of return. I'm still going to earn on the full $200,000 cash value. So I can use the money to go invest, get a rate of return, while I continue to earn compound interest at the same time.
How is that possible?
Yeah.
OPM.
How can they make money if they don't have that money to go invest other ways?
The insurance company does have it. So what they're going to say is, hey, Erica, we see that you have 200,000 in here and you want to use 100,000. Well, if you want to use what's called a non-recognized loan, well, guess what? Leave your money there. Instead, borrow our money. We're using OPM, right? Everybody in real estate's already freaking doing it.
Right.
Yeah.
Right? So that's what we're doing. Except with these loans, they say, hey, take our money. You can use it to go invest. Guess what? They're doing a simple annualized interest rate. So let's say that you have let's just use easy numbers. If you look at a 5% simple annualized rate, it's different than a bank loan. Okay, because if you look at a bank amortized loan, you're paying like 50% interest in the first 10 years over a 30-year mortgage, right?
Right.
So we have to understand the difference between a simple annualized interest rate and a bank loan amortized interest rate. So if we were to compare a 5-year, $100,000 loan at a 5% simple rate, that is equivalent to a 3.86 or 3.68, I can't remember off the top of my head, amortized bank loan over 5 years. Because of the way that banks, they front load interest.
Right.
This is
Gotcha.
a flat rate. It is what it is. It's just a flat rate. They don't compound it. Now, if I don't pay that interest that year, sure, it's going to roll over to the next, but it's just a flat rate for the year. So we're using OPM. We're paying a flat rate. And oh yeah, by the way, let's say that, and I actually had this happen to me. I have a new development for some single family houses that I'm doing. And we planned on legitimately this project taking 6 to 8 months. We started in February 2020 and then COVID hit, y'all. Okay, so this 6 to 8 month long project took about like 14 to 16 on one, and the other one took like 18, 19 months. Guess what? I did not have to make a single payment on that loan.
Which is amazing.
Not one. And I don't get ugly letters. I don't get penalties. I don't, no one's knocking on my door saying, you need to make a payment or we're going to put a lien on your house.
Because you're the one that sets it's my money.
Mm-hmm.
So,
It's collateralized.
yeah.
I mean, the insurance company doesn't care if I pay it back, because guess what? The cash, let's say, God forbid, if I were to pass away, knock on wood, right?
Yeah.
They can say, hey, Mr. and Mrs. Beneficiary, she has $1 million death benefit, but she has a $100,000 loan out. Well, here's $900,000 tax-free. Here you go.
Wow.
Or if I decide to cancel the policy and walk away, they'll say, hey, we're sorry to see you go. You have $200,000 in cash here, but you have a $100,000 loan out. Here's your $100,000 left. You know what I mean? So
Yeah.
that's to your point. Yeah, you set the terms of the loan, how fast you want to pay it back, when you want to pay it back. Now, you want to be a good banker. And so Nelson Nash, the guy who kind of coined the term becoming your own banker, he talks about being a good banker, but a good borrower, right? Mm-hmm. So we want to put money back in there. But we have to think about it differently. Like if I think about paying for a loan on my car or whatever else, well, I think about it as a cost. Like, oh man, like I'm paying this.
Yeah.
And, well, think about it this way. If I have $200,000, but I use 100 of it, well, now I only have access to 100. But if I pay, let's say, $20,000 towards my loan, guess how much I have access to now? Right? Like it increases the amount of cash value
Right.
that you have available. So me paying on my loan isn't a cost. all it does is go back into the cash value that I have available for myself.
So it goes back into
It goes back into my pocket.
into the piggy
But
bank.
the full 200,000 has been earning interest the whole time.
All right, I think I'm wrapping my head around OPM. So technically, you've got $200,000 in your whole life account, but you're not going to borrow your own 100,000. You're collateralizing the 100,000 that you're taking from the insurance company, so they will still pay you all the interest on your full 200,000.
Yep.
And dividends.
And dividends.
How much interest are you paying on the OPM?
So that's where it's going to vary per company. So we have some companies that do 4.5% simple, some are 5% simple. It kind of depends on the company, and which one you use.
And they're all simple?
Well,
That also depends.
It's going to depend. Now, the only companies I will use, especially if we're using it specifically for real estate or my business owner clients, right? We're going to use simple annualized interest rates that are non-direct recognition loans. There's other strategies you can do that aren't that way, but if you're using it in that I'm going to use it and pay it back and rinse and repeat process, then yeah, you need to use the simple annualized non-direct loans.
Got it.
Okay, so you are paying an interest there. You are still getting interest on your full 200,000.
Right.
You're paying simple interest on 100,000. So it turns out to be a lot less than what you're actually making per month.
Right.
So that's great too. Is there, that I kind of understand now. So it's before when you're hearing, oh, they're just going to keep paying you interest on the full 200,000, I'm like, money is not free.
Money is not free. You're absolutely right. And it's it's arbitrage, right? That's what the banks are doing. They're paying you a little bit so I can turn around and earn more from you. Well, that's what I'm doing, right? As becoming my own banker, I'm going to pay a little bit to go out and earn a lot.
Right.
And that's the thing. We have to realize that if I'm earning, let's say I'm earning 6.5% between guaranteed interest and dividends, but I'm paying 4.5%.
You're still making 2%.
But I'm not, because remember, that is just looking at the spread.
Yeah,
That
right.
doesn't actually calculate the actual internal rate of return that's going on. Kind of like the banks, right? If I pay you 0.02 and I'm earning 6, that's not a 5.98 return, right? So from our end, and it depends on the deal and how long, and there's internal calculations we can go into way deep.
We can get
calculations.
super complicated here.
In my simple computation of return on investment, that's called an infinite return.
Well,
If you're not putting any cash into the deal and you get X amount of dollars back, so 0 divided by however much you get back, that's infinity.
yeah, you have a cost of doing business, right? Like just like anybody else. And my business owner, like I actually stole that from a business owner client because he has multiple trucks and he's like, that's just a cost of doing business. He's like, yeah, I'll pay 5% simple.
Yeah.
That whatever. Now, here's the thing, like when you're doing that again, you have to understand the arbitrage. There is a difference between the spread and the actual IRR. So borrowing and using and all of that, we help people understand. And here's the thing, we're not transactional where we just, oh, here's a policy, there you go. No, like we've done deals with clients, we work with clients, we help them analyze and say, hey, what is the best way to do this? Do we want to pay it back on a 3-year, 5-year, 10-year schedule? Or do we just not want to make a payment on it for 2 years and pay it back all at once? Or, right, we go through those computations with people. And actually, we're Infinity Investment Strategies. We do strategies with people, right?
Well, and I think that's important just because, like we said here earlier, like we've talked to people about infinite banking before and still a little perplexed at the end of the show, which is why you're here. But because it can get so complicated, because there are nuances, but the actual structure of it is pretty simple.
Well,
and then it just depends on what you're doing with it.
Yes.
And having somebody there to like guide you through it, because most people don't even understand, and infinite banking gets such a bad rap.
And
does.
that one caveat right there, that you're not borrowing your own money, you're borrowing the insurance company's money, and you are paying them interest
Yes.
on that money. Now, yes, you are still making more money than that, but I like it because
Yep.
that was a part that I'm like,
Well, people are skeptical of it because they're like, that can't be true. Like, you're trying to pull a fast one on me, and you're not being transparent if you're trying to tell people, oh, you're just paying yourself back. No, you're not.
Yeah.
Like, I guess in a roundabout way, sure, kind of. But, if you really get down to the brass tacks, you're paying the insurance company money, and they're like, well, why would they do that? That's an easy way for them to make money, right?
Yeah. Why did the bank
That's
borrow
just
money?
another
That's
stream
just
of revenue.
another- yeah.
They're going to pay you your guaranteed interest rate regardless because it's in the contract. So if they can make a little bit of money on the side because you're taking out a loan, then it's a win-win.
Yep.
So
All right. $200,000 is a lot. How much can you fund? So just say me, and I'm walking in today and I've got, JER'LEIGH selling a condo for me. I'll get like 50 grand. That'd be nice. Can I go plunk that down into a whole life policy and start borrowing on that?
yeah. So
Taxes?
how does all that work, right?
Yeah.
Right.
So these life insurance policies, if we go all the way back, like I mentioned, they predate the IRS, right? So back in the day, people were dumping lots and lots of money into it and all of that. Well, then you start, and this is before the IRS, but while the income tax was actually getting implemented, right? So there was that little gap. Of time. So what the wealthy would do, and there's actually books about this, like what would the Rockefellers do and all of that, right? They would take these policies and let's say they buy like a $10,000 insurance policy, right? And they turn around and dump $500,000 of cash into it because they understand the post-tax Roth-like benefits of these accounts. Well, IRS gets created, they start realizing what's happening. They're like, whoa, 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 whoa. Hang on a minute.
Yeah.
Like, we don't like this. Uncle Sam's missing out on part of the pie. So they step in and they say, this has to at least look like a life insurance policy. So to your question, what is the max? There is no max. Like you can buy whatever your, and this is going to sound morbid, but your economic life value, right? Like what is your earning potential in your lifetime that if you were to pass away is reasonable for them to pay out kind of thing. So you have the ability to get whatever your death benefit, your economic life value comes out to, okay? So there is no max other than what you're eligible for, but whenever you're going to put cash in, the IRS has set limits as far as how much cash can you put in compared to your premium. So when we think about a premium, right, like that's how much the actual life insurance policy cost. That's what most people think of with life insurance. Oh, it's going to cost me something.
Yep.
So think about it like so real estate, right? If I buy a house, I have a mortgage payment.
Yeah.
Right? Yep. Well, number one, that mortgage payment is dependent on how much house I buy.
Yep.
So everybody wants to know, well, how much is how much are these policies going to cost? How much does a house cost? Yeah, like how much house are you going to buy, right? Like how much death benefit do you want? So that's customizable. But the point is, if I buy a house and my mortgage payment is here, well, I know for sure if I want to pay over and above on top of my mortgage and go straight to principal, can I?
Yeah.
Yeah.
Does it build up my equity faster?
Absolutely.
But am I obligated to do that?
No.
These policies are set up the same way. You can put over and above. So I'm going to use that $10,000 example. If I
After
buy,
tax dollars.
after tax dollars, yes, after tax dollars.
And it's important to. It's not like you can escape taxes.
No.
So you got 20 grand that you want to put in 1 month. You can do that, but you better have paid your taxes on it.
Yes, it's like a Roth type account. Exactly.
Got it.
So if you, again, I'm going to use that 10,000 just as an easy number. So if you have 10,000, you could put, let's say you put 15,000 in. Well, that 5,000 is going to go straight to cash. Okay, so that's where we have to figure out what is the limit. Now, the IRS, generally speaking, and it's going to vary on age and health and all these other things, it will use a number anywhere between 3 to 5 on the high side. So 3 to 5 times your base premium is how much cash you can put in. So if you get a $10,000 policy, well, depending on that specific person and the way that the policy is designed, you could put an additional $30,000 to $50,000 of cash in immediately.
Immediately. And borrow from it.
And borrow against it. Now, depending on the company, you might have access to, 95%, 98%, 90% of your cash. So if I put in, 50, I may not have access to all 50. I might have access to like 47,000 or whatever it might be. Because what happens is when you put that cash in, it's going to increase your death benefit at the same time. One of the biggest things people say is, oh, well, if I die, I only get my death benefit, I don't get my cash value. Well, technically that's true, but there's two things. One, your cash value, when it goes in there, increases your death benefit. So technically you're getting the cash value, but here's the beauty about the way that these things are designed. I love this. This is beautiful. So especially in Texas, but when you put money into a policy, these policies are protected under the IRS code as a life insurance, as a part of your estate. So when you put this cash into your policy, it increases your death benefit. So when it pays out, it pays out completely tax-free, even the growth. Wow. Even the growth. So yeah, I want my cash value to increase my death benefit. I don't want it to get paid out as cash. I want it to get paid out as death benefit.
Death benefit.
Part 2, Texas 100%, and a lot of other states do too, 100% protects these policies against creditors, predators, bankruptcy, being sued. So when I put cash in, because it's tied to my death benefit, I can't
Nobody
get
can
sued
touch.
for that.
Wow.
If I have a clumsy tenant, or, so it could be something outside of work, right? Like we're in Dallas, right? Like traffic here is ridiculous. So if I rear end somebody and their neck hurts a little too bad, right? They want to come after me, my house, my dog, whatever. They cannot touch my life insurance policy. And because your cash value is tied to the death benefit, guess what? You can't touch that either. It's
Yeah.
protected. Though, and most states, again, they kind of vary on how much they do it. California, obviously, they're the bottom as far as how much protection they offer, and their protection's at 50%. So anywhere between 50 and 100% protection of how these
But in
policies are
Texas,
treated.
we're protected 100%, which is amazing.
And let's say that, you sell your house and you decide to move up to Colorado. You started your policy in Texas, so it follows you.
Oh, so whatever applies in Texas is
Because you started
Yep.
it here, you're a resident here. If you move, then whatever.
But we're still Texan.
We're still Texan. Yep. You're
Nice.
lifelong Texan from there.
Lifelong Texan.
So the design on that, I guess, kind of coming back to that, it's really important to do this correctly. And if I'm going to tell anybody anything, setting up a infinite banking policy, you have to do it with an authorized infinite banking practitioner. You can go to infinitebanking.org and find a practitioner who has been through the education, has the license, has the regulatory authority that is watching over them, making sure that they do this right. And I say that just because, we've talked about if
there's a lot of shady.
Does
stuff.
does the policy have to be fully funded in order to start borrowing?
Yep.
So you want to start with a smaller policy.
Well, yes and no, because what'll happen is, let's kind of come back to that house analogy. You pay your mortgage, right? Well, if I only pay my mortgage payment, right, for the first year, am I going to have equity in the house?
No.
No, because there's an acquisition cost,
Yeah.
right?
Right.
Realtors, title, everything, right? So I've got to overcome that. The same now, every single month though, more and more and more of my payment starts going to starts going to principal as opposed to interest. In your policy, the same thing happens. If I make just my base premium for the first year, I'm not really going to see any equity, any cash value from that, right? The only way to get cash value in the first 2 to 3 years is by doing those cash dump-ins. I said PUA earlier, it stands for paid up additions. Those are interchangeable. That's just the cash dump-in. So in the first 2 to 3 years, you want to just have whatever your base is that you're comfortable with, your cash dump-ins to go on top of that. That's going to supercharge your cash value to get it going, to give you the ability to start borrowing against it, right? You want to funnel as much cash as you can in. Now, what we start to see, though, is every single year, just looking at the base, if I do $10,000 in year 1, 0 cash. My next year, I do my $10,000 base. Oh, well, now let's say $4,000 of my $10,000 base is going to cash. And then next year, my base goes from increasing it, I put in 10 and it goes up by 7. So now we start to see you're overcoming the acquisition cost within the first 2 to 3 years. This isn't like a brokerage account where you have that management fee of 1% forever. No, they get it all out of the way up front and you never have another fee again. So, and that's why, like, to your question, you don't want to always get the smallest base. That's not always the best way to go. You don't want to cut your nose off to spite your face, because your base is going to start going to your cash value, and however much base you have is because of your death benefit. That's what drives your dividend. So the more death benefit, the more base you have, the higher your dividend is going to be, which is what's going to be really contributing to your growth the most after about years 6 and 7.
So let me get this straight, just because I feel like I kind of glazed over there for a second.
We went real deep on that one.
I'm like, okay, wait,
She's like,
am I
wait,
following? Yeah.
My name is JER'LEIGH.
Yeah. Like, where am I?
I need to go shopping for oranges later. Okay.
Anyway, whenever you're paying that premium, you're saying that I'm only paying a premium, like that only goes on for a finite amount of time right in the beginning, and then I stop paying that premium?
Normally, you're
Yeah.
going to want to pay that premium extendedly.
Okay.
Right. Now, can you at some point decide, hey, it's been 5, 6, 10 years, whatever. If you want to stop, you can. But if you were to put $10,000 into something and it grow by 15, would you stop putting money into it?
No.
Okay. So
Yeah.
can you? Yes, but you're not going to want to, because this thing it's compound interest, right? Albert Einstein calls it the eighth wonder of the world.
Yep.
That's what infinite banking is predicated on, is never losing compound interest, because that's where if I'm earning interest on my money and then I have to take it out to go use something, well, I interrupted my compound interest curve and I have an opportunity cost. Well, because when I take my money out, I don't lose compound interest. I don't have that opportunity cost. We get to take advantage of both.
So once you've fully funded your cash policy, right, your whole life policy, you could stop making premium payments then, but you're saying even if it's 10 years, you still want to keep making, because that will just grow and grow and grow.
Absolutely.
Because once you've funded it, then all of it goes to cash?
Yeah.
100%
Once
of
you've
the
overcome
premium.
100% and then some, right? You start getting more bang for your buck. So, I mean, I know for mine, what am I? I guess mine's not a good example because I had to restart another one. But let's say you get into like year 5, and again, if you're doing a $10,000 policy, well, year 5 or 6, now you're putting in 10, you're getting out at least 10. And then we see policies that are 8 or 9. Again, it depends on age and health and all of that. But if you put in 10 and you're getting out 20, that's not unachievable. We see that all the time because the policy is supercharged up front with the cash dump-ins. But then as it starts to take off, right, we're just going to focus more on the base, on that premium side.
How often can you do cash dump-ins?
Whenever.
Whenever you want.
Whenever you want.
Whenever you want.
Exceed, but like you were saying earlier, you can't exceed.
You cannot exceed the IRS limit in your contract year. So if I start a policy in November, I have 1 year to put in however much cash I have available. Now, a little bit what we do, so some insight here.
Little tip.
Tip.
We've been doing this for a while, and we set these up because, again, we work specifically with real estate investors and business owners. We know that sometimes revenue takes a little bit to come in. Sometimes deals take a little bit longer to close. So if I miss, I'm like, oh, my contract, what am I trying to say? My property is going to close in October, so I can do this dumping in November. Well, God forbid that property take longer to close.
Right.
Yeah.
And it doesn't close until late November or December, and I miss my deadline. Well, crap. I missed. Well, guess what? The way that we structure our policies and the way that we put them, like my business partner David White and I, the way that we structure these companies allow us to do a 2-year look back. So if I miss my deadline, I can put in for the year before.
Wow.
And this year. Now, we're not going to get the full interest for that year, but at least we have
You
that
didn't
corridor.
miss that whole opportunity.
Exactly. So the way that we structure these is, again, because we work with business owners and we work with real estate investors, we build these to be flexible. So number one, you can go back and do that if you need to. But let's say, and this is usually what happens, I start doing a $10,000 policy, a couple years go by, my income's gone up, my business is growing. Well, crap, I'm putting in $10,000, I can only put in, let's say, $40,000 cash,
Right.
so I'm saving $50,000 total. Well, Erica, I don't want to do 50. I need to increase this to 75.
Or I want to do $500,000.
Or $500,000, right?
Yep.
So we structure these policies so that we're going to go for the max amount always, with creating that base amount, that premium that whoever it is that we're working with is comfortable with. We have people that do $5,000 policies. We have people that do $500,000 policies. It's a huge range, but they're all built so that they can grow and expand with each person over time. And that's the key, is being able to increase your premium and being able to increase your cash every single year if and when you're ready.
So once a year goes around, you can increase your base if you want to.
If it's designed correctly. If it's designed correctly is key.
And that's good. So somebody like myself creating one of these accounts, how soon, realistically, how soon could I start borrowing from it?
So let's say Monday rolls around and you start your policy, you sign your paperwork. It takes 3 to 5 days, honestly, for them to send the request to the bank sends it, right? So I would say in a long transaction time, it would take probably 5 or 6 days to be able to turn back around and loan your money out.
Wow, really?
Yeah.
Wait a
Now,
minute. Okay, I'm hearing that, but you have to have a fully funded policy.
Now, yeah, so let's use that 10 and 40 example. If you put
Right.
in 10 and you put in 40,000 of cash and you have access to, I don't know, 38,000 of it or whatever.
Right.
You can, once that money's in there, and you say, hey, I want that, you call them and say, hey, send me $38,000. The only thing they're going to ask you is where do you want it sent? They don't ask you why. They don't ask you what it's for. They couldn't care less. Are you going to pay? They don't care, right? And oh yeah, by the way, it doesn't show up on your debt to income. You don't have to report it to the IRS. It doesn't hit your credit. It's complete. This is privatized banking, y'all. Like, this is completely private, behind the scenes. Nobody knows it. Now, it's legal. Let's just be clear.
Yeah.
But it's all done through these contracts that are private. It's a unilateral contract, right? So you're in control. You make the changes. It's just mano y mano with the insurance company. The bank doesn't know, but you do. IRS doesn't know. But let's say that you go and I want to sign on a loan for a multifamily deal or a house or whatever, and they want to know how much liquidity you have, or they need to see a PFS for your personal financial statement. You can use 100% of your cash value as liquidity and net worth. Lenders love it.
Huh.
Lenders love it because it's liquid.
Yeah.
Even if you've already borrowed.
No, now you have to give right now.
Okay,
With that 100,000 example, you can only do whatever's available.
Okay.
But we're doing on my house. Whenever I had to show liquidity for my own personal net worth, a lot of lenders now include cash value as a part of their questionnaire because now if you were to use a brokerage or a 401k, they might. If they even give you recognition for you, they'll give you up to 50% of whatever's in there because it's tied to the market.
Yep.
And you have to pay taxes and penalties to get it out of a retirement account.
Yep.
So these policies, they love them because they're guaranteed. They're not tied to the stock market. There's no penalties to get it out. It's just there.
Interesting. So what was it, do you remember whenever we were talking about this before, they were talking about with infinite banking, you do have to have, there is a due diligence of making sure, like a method to the madness of making sure that the payments are being made by a certain time, that you've just got to be very diligent about.
You want to be diligent, right? You want to be a good banker and a good borrower, right? So
But put it on auto pay and forget it?
you can put it on auto pay, or you can pay it like if I'm invested in a multifamily deal and I get a K1, well, if you get a distribution from anything that you do, where do you put your money?
In the bank?
In the bank.
In a checking account?
You're going to do the same thing. When you get your distribution, instead of putting it into your traditional bank, you just put it into your regular bank. And you can either put it in as a cash dump in if you want to. So you don't even have to pay your loan back. You can do a cash dump in without paying your loan back. Or, right, because if you're like, oh, I want to use this cash, whatever. So you can put it in as a cash dump in, or you can say, I want to put this back as a loan. But if you pay your loan back, all it's doing is increasing your cash value availability anyway.
Yeah.
So you're going to pay that back. And so as far as like what the method is and what the due diligence is, I don't know exactly what they're referring to. You want to
you were.
you want to be responsible with it, right? Like don't take out a loan and then never pay it back because you're gonna you have a little bit of a spread there for your interest rate, but you're not really capitalizing on the compound interest component.
You're not using it correctly, basically.
Right. You're not going to see the scalability that it really can do.
Gotcha.
Okay, so you've borrowed money, you get proceeds from something, you put it back in, you just do a cash dump in. But you're saying you don't have to pay back that loan, but isn't it advantageous to pay back that loan?
It is advantageous to pay back the loan.
Okay.
Yeah, it is. You could, if you want to, I have to get my cash dump in right now before, November or whatever your deadline is, you might want to get your cash dump in.
Oh, well, that makes sense.
Right.
Okay.
That makes sense because then you increase your borrowing power by getting your cash dump in, and so I see that you would want to get that as high as you can.
Yeah, so you might think, oh, well, I'm going to get another payout here in like a month or so, but my policy is going to renew in a week, so I need to get this cash dump in, and I'll pay the loan back in another week or two or whatever.
So if you have a $10,000 base policy and you go up 3 to 5 times, you can put in $40,000 cash dump in every 12 months.
So, and then as far as if you're taking out this policy, I know you said it depends on what they say. Basically, your life is worth, so to speak.
Yeah.
Then do you go and take out, like, all right, I've maximized this. I've put everything in, and I can't go. I've reached my limit.
Yeah.
Then can you just open another one?
Yes, good question, and that's very, very common.
Okay.
Especially, here's the crazy thing, like, a lot of people we work with, they're kind of skeptical about this. They're like, oh, I'm going to try this, and I'm going to get this little policy. I'm just going to taste it and see if it's okay.
Yeah.
And they start using it, and they're like, oh, crap, this is pretty cool. The more they use it, the more they use it, right?
Yeah,
So
yeah.
we've had people, I have one guy in particular who I'm thinking of, opened 3 policies in 2 years.
Wow.
3 policies in 2 years, and then got one on his wife because he just, well, 1, he kept increasing his income, but 2, he just started maximizing it. And so it isn't uncommon. In fact, like I have one, my husband has one, I'm getting another policy on myself because I have fully maxed mine out. But I'm like, I want to continue.
How do you fully max it out?
Good question. Whenever, let's say we have a max economic life value, I'm going to use big numbers. I'm going to say like 5 million is my life value. Okay. If you were to do 5 million in permanent insurance, that's going to be rather expensive. And a lot of people aren't going to want to commit to that right off the bat. So what we will do is we're going to structure these to where we're going to have a permanent insurance, let's call it, I don't know, 2 million. And so if you do that 2 million, that might only give you the ability to put in 3 times your base premium. Whatever your base is from that, you might be able to do 3 times your base. Okay. Now, what we will do on top of that is we will add a term insurance policy rider on top of it to give you your full 5 million life value. But because we're using term, it's stupid cheap.
Okay.
Ridiculously cheap. Now, term doesn't get any cash or any of that.
Yeah.
But you know what it does? It does a couple things. One, it opens up your corridor from only being able to put in 3 times your base. Now you could put in like 5 times your base. So it increases the amount of cash that you can put into your policy because you've increased your death benefit.
Okay.
Right?
Okay.
So your death benefit, if you look it up, it's called the MEC, Modified Endowment Contract. It's a stupid algorithm. I don't know how they do it. But anyway, that's what they're calculating is they're looking at the comparison of what is your premium and your death benefit compared to your cash. So if you add that death benefit on top of your policy, that's how it increases the amount of cash you can put in. Now, let's say your premium, again, $10,000, 2 years goes by and you're like, hey, I want to increase my premium from 10 to 20. Well, all we're going to do is take some of that term that you got 2 years ago and we're going to convert some of it. So now your premium increases from that 10 to 20. No health checks, no questions. It doesn't matter what happened. My business partner, so I've talked to him about this. Like we've had a couple of experiences where there have been people who get an insurance policy with a term rider and, you know, life happens. Like we get health scares or things happen. And this person had that structure, became uninsurable, actually had like a mini stroke.
Wow.
Right?
Yeah.
In their 30s.
Oh, wow.
Yeah. And so at that point, they're uninsurable. Like insurance isn't going to touch them with a 10-foot pole. But because they have this term insurance rider on there, they have to convert it at the same health rating that this person got years before because it's locked in. Right? So you can convert that term insurance whenever you're ready. All it's going to do is increase your premium. It's going to increase the amount of coverage that you have permanent, but that's also increasing your dividend.
But then all of a sudden it's maxed.
And then all of a sudden it's maxed. So yeah, now I've increased. Yeah. Now when I increase my base to 20 though, well now instead of only being able to put like 40 in, well now I'm able to put in 80.
Right.
Right. So as I increase my base, my cash value availability increases as well.
Does that start the clock over when you increase your base?
What do you mean?
Well, the first year, most of it is just you paying.
Oh, I see. On the acquisition cost.
On the acquisition
Only on the
cost.
portion that you convert.
Okay.
So everything else is rocking and rolling. But if I convert, let's say I convert 500,000 in death benefit, whatever that portion is, it's going to have it usually takes about a year.
A year to pay off the acquisition cost.
Yeah.
Gotcha.
Because at that point you've already, started that compound interest. We call it rocket fuel. So if you think about a rocket, it uses about 70% of its fuel to get out of the atmosphere, right?
Yes.
And that's the shortest part of the trip. So once you can break through the atmosphere, everything else is just coasting.
I love this.
Yeah,
I love
that's
everything
awesome.
about this. I actually get this now. I understand
I told you I
it.
knew my stuff.
No, I mean, sitting here listening to her talk last night, I'm like, she's passionate, she's sassy. I go, and I'm like, and she can explain it and let a third grader understand it. I'm like, I actually get this. I have never been. How many times have we done this?
Yeah, we talked about it, and I
told Kristen, I was like, I'm not trying to brag, but I was like, she's like, well, I've talked to a couple of people and I don't understand that. I was like, that's because you haven't talked to me yet. Like,
Literally what she said. I'm like, this makes complete sense to me.
Good. I'm glad to hear that. I really am.
So we can get started quickly, because that was the other thing. When I'd heard it before, I was like, okay, great.
Maybe
so
I
I'm
need to
going
read a
sock.
book. Maybe I need to do a little more research. I'm not doing. That was.
Was how we walked away with it. And then I said, well, gosh, do I really want to take $20,000 and look forward to being able to borrow from that in like 3 to 5 years? I don't. And that is why I've never pursued it, because I'm like, I just don't want to tie up that capital.
Yeah.
Yeah.
Doing
well,
that.
yeah, because that's the, you're thinking about what is the opportunity cost that I could have done, right?
Yeah.
Now, if we compare, let's say you have, you and your clone, right? Like my business partner uses this analogy all the time. Your clone, if they took 100% of their capital and invested it into real estate, they're going to get a faster start, right?
Yeah.
Right.
Because you have that acquisition cost to overcome in the first year, couple years. But it's kind of like the tortoise and the hare. They're going to start off as the hare, but after you overcome your acquisition cost, when you're using your cash to invest and you're earning this rate of return inside at the same time,
Yeah.
and you're able to compound what they're doing, right? You're getting the same returns, but you have that additional return because of the arbitrage inside of your cash,
Yep.
right?
So, but you could still borrow and borrow from yourself
Mm-hmm.
at a lower rate and, more importantly, easily.
Yeah.
Yeah.
Which is what I like about it.
Well, and here's the thing, like it's the arbitrage is awesome and it's fantastic and I love it. Obviously, it's really it's really powerful for people. There's the control element, like I get to dictate the terms. I get to decide how much I'm putting in, when I put it in,
What I
when
want to spend it on.
Oh my God! And
Yeah.
I'm sorry, I'm just gonna say it. Self-directed IRAs frustrate me because the R in IRA stands for restriction.
Please don't be.
Restriction.
Shut it off. Haley, if you're watching.
sorry.
She was in the
know.
audience last night.
Yes, and I have clients that use self-directed IRAs, and I have used them, right,
Yeah.
for my pre-tax dollars, like rolling over 401ks. There's no such
There's
thing.
a purpose.
Exactly. There's no good tool, there's no bad tool,
You
right?
have kids.
Yes.
And I talked about it last night on the panel.
Yeah.
And I just said, Quest has been a lifesaver because I am paying for private school
Yes.
in half the time.
Yes.
Now, okay, it's a little less than half the time. But when
Yeah.
you're used to paying 48 cents of every dollar because you're self-employed,
Yes, and that's huge.
your self-employed tax, your state tax, all of that,
Yep.
everything that you are paying, you add that up, it's 48
Mm-hmm.
cents of every dollar. So instead of, I'm literally paying for private school, any educational costs,
Through your
and then
IRAs.
university, and then grad school up
Yeah.
until the age of 30.
Well,
for
that's
my
a
kids.
perfect example of using the tool
for the job.
Yeah.
And
yeah.
you're
But
exactly
this is
right.
something completely different.
Yes.
Well, especially when you're looking at, taking advantage of one of the number one reasons to get into real estate is depreciation. And so when you invest with an IRA, you miss out on the cost segregation, the bonus depreciation, and that's really frustrating for a lot of multifamily passive investors. And so when you're investing with an infinite banking policy, it's the same as cash. So you get all the depreciation, you get all the cost segregation benefits. And so I'm like you, like I stopped funding 529s. I don't do that anymore because when I go, let's say my kids decide to go to, they go to college and I want to fill out the FAFSA, right? They can use my IRA, my 401k against me. I don't have to disclose what's in my infinite banking policy.
You're kidding.
It's private.
Wow.
Warren Buffett refers to this asset as the vault. So think of a
Yeah.
vault like in your garage or basement, right? You
Nobody
can put money in
knows.
when you want. You
Yeah.
can take money out when you want. It's safe and protected. And who knows how much cash you have sitting in your vault?
Only you.
Only you, unless you
Yeah.
decide to show your cards. So I don't fund 529s. I put it into my life insurance policy. So if my girls decide, hey, I want to go to college, I can pay for it using my life insurance policy. Really, what I plan on doing is letting them take out the unsubsidized loans that don't accrue interest. And then guess what? I'm going to let my cash value earn interest for 4 years. And then whenever they're ready to, graduate, they can pay some, and then I'll pay off half of it with my
rest.
policy that's been earning interest while their loans have been sitting there not accruing interest.
Right.
Gotcha.
Right. But I didn't have to disclose anything to FAFSA, scholarships, right, anything like that because it's private. I
Exactly.
don't have to tell anybody.
That's fantastic.
It is fantastic.
And I will say the one last piece of this is I think most of us that are in this entrepreneurial business, real estate, whatever, everything that we do is focused on creating cash flow, passive income, right? These policies are just another cash flow asset. So you're going to get to the point where, right, like we want to go to the beach and have margaritas and sit back and I don't want to do anything and I don't even want to put money into my policy. Well, now I'm in my 50s or 60s or whatever, and this policy that's been accruing cash for however long, well, it has cash in there. I can say, hey, I don't want to put money in here anymore. I just want you to pay me. And you just flip the switch and they will pay you a guaranteed tax-free stream of income for the rest of your life. Wow. And then whenever you die, your death benefit gets passed to the next generation completely tax-free. So you use your money while you're working tax-free. And then when you're in retirement, you can draw on that tax-free.
Tax-free.
And then when you pass away, everything gets passed along to the next generation tax-free.
That's amazing.
Wow.
It's very powerful. That's why, like I said, the Rockefellers used it, and a lot of the wealthiest families
Use it.
McDonald's. Ray Kroc actually used his personal cash value policy to fund marketing for McDonald's. Walt Disney, whenever he wanted to start Walt Disney World, he went to the bank, asked for a loan. He has a successful movie production company, right? They wouldn't give him a loan for a theme park. The bank would not give Walt Disney a loan for a theme park. So he said, fine, I'll do it myself. Took money out of his life insurance policy, and that's the first money funded into Disney.
Wow.
Rockefeller Center in New York City. J.D. Rockefeller wanted to build this monstrosity, and he went to the bank, and it happened during the Great Depression. They would not even give J.D. Rockefeller a loan, right? So he, and all of his ego, was like, fine, I'll do it myself. That is the largest privately funded construction project ever. He fully funded the construction of Rockefeller Center in New York from his personal cash value life insurance policy. The only way he was able to do that is because it's not tied to the market, so it wasn't down. There's no restrictions, right? So he didn't have to pay it back until he was ready to. And they couldn't tell him, no, it's his money. Same thing, JCPenney. Oh, this is a cool thing. One more thing I'll say. JCPenney. Y'all look
But yet, there's more.
Wait, there's more. Look up BoliColi, BoliColi. That stands for bank-owned and corporate-owned life insurance. So if you go to Chase Bank or whatever and you say, oh, what should I do with my money? They're going to tell you to put it in mutual funds or whatever crap. What they're doing behind the scenes, they have bank-owned life insurance policies where they hold a majority of their assets in these policies specifically within their entity. Wells Fargo has 53% of its cash in a BOLI.
Wow. Really?
Yep. JCPenney, Great Depression, same thing. All of that happens. They're retail. They're not making any money, right? So they can't afford to pay for anything. They take out a loan against their COLI, their corporate-owned life insurance policy, and they use that to pay every single JCPenney employee throughout the entire Great Depression. Again, they knew they didn't have to pay it back until the economy recovered, and it wasn't tied to the market. So it's great to think about the opportunities and cool and arbitrage, but it's really like not if, but when things happen, right? Like
because it's all up and down.
Exactly.
What goes up must come down.
You need to be able to dust your knees off and recover and leverage yourself out of those situations.
And
Absolutely.
There's one more thing we need to touch on. One more thing. And so I just want you to explain, who all can you take life insurance policies out on? And how many can you take out on each person? So, for example, my business partner is health problems, not insurable. Her husband, not insurable. Can she get one on me?
Yep. She has insurable interest, and she would get a key man policy. So you can get policies on your spouses, on your kids. I know that sounds morbid, but y'all, here's the thing. This isn't anticipating, oh, my children, I can't even say those words, but I know people who are in their 30s and their 40s with a life insurance policy that grandma got for them when they were 5. And this puppy is just purring, or I guess this kitty is now purring or whatever, right? It's just singing at this point. Like, imagine having a life insurance policy somebody set up for you 25 years ago.
And it's just
and now
premiums.
it's
just rocking and rolling, and they're like, look at all this cash I have. Like, thanks, Grant. Like, it's incredible to be able to set your kids up with that, right? So to answer your question, you can set a policy up on anybody that you have insurable interest on. My daughter's dad, I can get a policy on him, right? Like if you, and I'm using this example, we had this happen where mom, dad, they weren't together. She wanted to get an insurance policy on dad because if he were to pass away and he's paying child support and she would miss.
Yeah, that's a loss of income.
Exactly. That's a big deal. So you can get an insurance policy on anybody that you have an insurable interest on. They're going to have to sign off on it, right? Like they have to know you're doing this.
What about for minor children?
You can do it for minor children as long as they're over 6 days old.
But do they sign off on it?
Or
No, you're the parent. You're the parent.
You're signing for them, right?
You're the parent. You're the guardian. So you have the ability to sign on that. You can be the owner, and the beneficiary. They would be the insured. And then, later on, if they want to take it over, they can. Or if you want to just keep it, you can, right? Yeah. It's totally up to you. Now, how much can you get on them? That comes back to the economic life value. So like for your kids, they can only get up to 50%. Most of the time, there's extenuating circumstances, but they can usually only get up to 50% of the death benefit that the parents have.
Wow.
Yeah.
Okay.
So.
But if you've got $5 million on yourself, that could be $2.5 million on your kid.
Yeah. Now you're gonna have to justify that, but it's not impossible.
my kids are pretty valuable to me.
I'm telling you, but that's a real thing. I mean, if we really.
But I can borrow from that. How many can you put on yourself? Because you said I've maxed out one. I've now started a new one.
Whatever your economic life value is. So if my value is my value is $5 million, but I only have a $3 million policy. If I haven't,
then you can start another one that's 2.
Yep. I just have to tell them what I have. That's all they want to know, right? Like Nationwide isn't going to take a Ford Focus and insure it for $500,000. Yeah, and I'm like, nothing wrong with a Ford Focus, but I'm just saying.
How do you? I mean, do you have to sit there and prove how much you're worth?
They just ask about, how much do you earn? If you're over a certain amount, they're going to want documentation, but most of the time it's not. We really don't go based off of death benefit. We're going to ask somebody, like the big question is, how much do you want to put in this thing on a minimum basis every year? Like, what's your minimum savings goal? What's your maximum? And where all the creativity we do in the background is kind of designing a policy that's going to get you the most cash up front, but also have that long-term growth, because you don't want to cut off your nose to spite your face.
Ooh, I got another question.
Yeah.
So what would be, and I know all of them are different, but on average, if we're dealing with a $10,000 base, what would the premium be on something like that?
Well, the premium would be that $10,000. So do you mean like the death benefit? How much death benefit could you get for that?
So wait, is it the base? Is that what you pay per month?
Yeah, the base and premium, those are kind of like base premium. That would be like what you pay annually or monthly.
Oh, that's annually.
Annually or monthly or whatever. Yeah.
Okay.
Most people pay it. It's best to pay it annually if you can.
Oh, really?
So just $10,000, you write a $10,000 check and
that's
start
for the year.
For the year. Okay, so
if
you wanted to pay
do.
it monthly, would it be like $1,000 a month? Is it more?
Yeah, it's a little bit more. Like, you know how it's same thing with car insurance or a gym membership, right? Like, there's that little modal charge if you do it monthly, because it costs them money
to
keep
send
up
to the
with
bank.
Yeah. So,
okay.
yeah.
So a $10,000 base, but then you can do a cash dump on top of that. So really, I'm sure you've got spreadsheets and whatever in your office to say, okay, what do you want to do here? How much do you want to put in?
Well, our process is the very first thing we do is we go through 101. And we typically go through the 101 class with everybody we meet, even if they are familiar with infinite banking, because we just want to build a solid foundation, right? Because
and also there's that, like we talked earlier, like our perception and my takeaway from that first time I started hearing about infinite banking or just discussing it or doing some research, my takeaway is totally different than like what you're discussing right now.
Yeah.
So
and there's preconceived notions and all sorts of so we always will go through the 101 just to kind of lay the foundation and really get basics out there. And really our big thing that we talk about again is the no good tool, no bad tool. You have your bank account that will give you liquidity and safety, but there's no growth. You have your investments. They give you growth, but there's no safety and liquidity. So we kind of have this, I'm darned if I do, darned if I don't, right? So I can put money into an account for the next 12 months, or I'm losing money due to inflation, or I can lock it up for 7 or 10 years or more. Well, most people have like this gap here. Like, well, what about all this time in between?
Right.
So again, we're not saying that it's better than the other. It's not. It's just a way to bridge the gap between our short-term and our long-term investments and fill in all the holes that aren't being addressed. You can have safety, protection, tax-free, right? Guaranteed, growth. And so if we think about it in these 3 boxes, my visual I walk people through is I'm like, okay, bank account, your IBC policy, and your investments. You take money out of your bank account and it goes into your IBC policy. You borrow against it to invest. You pay your policy back through those cash flow investments. But guess what? You have arbitrage. So now you have more cash flow going into your bank account. Now guess what? You rinse and repeat the process. You put more money into your policy, and you rinse and repeat. So that's kind of like our visual where, I draw this, infinity symbol.
Infinity symbol.
And that's our, that's our logo. So, just throw that out there.
She just walks you through it.
Yeah. So, and that's, we have the 101, and then 201, we actually start talking a little bit more about strategy and actually going through a real estate scenario. Like, how would you actually use this in a real scenario? Looking at arbitrage, future value. And then at the end of that conversation, we actually kind of go through a more specific questionnaire, like what do you want to see? And really digging into that person and what they want. Then when
everybody's different.
Everyone's different. So then in meeting 3, we'll come back and say, hey, you wanted to see these numbers. Here are your numbers. And here's what this looks like. And we usually do that during the underwriting process just to kind of give them an idea of this is what your specific information can look like based off of all of the information we went through previously.
Gotcha.
And from there, people can say, I like this, I don't like that. Can I have more? Can I have less? Whatever. And we, it's a completely tailored process.
That's awesome.
It is awesome.
I love it.
All right, so let's say that you decide to pay your premium monthly. And then all of a sudden you do a flip and you have like a big chunk of cash. Can you just put that in there?
Yeah.
In that 12 months?
Yeah.
And it'll fill up your base?
Yeah, it'll pay. If you want to pay your base, you can. If you want to put it towards your PUAs before you've paid your premium for the year, you can do that. And that happens a lot with our flippers and our wholesalers, right?
Right.
Like that last week we had a guy, he's been God bless him, he's been trying to get this house sold and it's been such a pain in the butt, and he finally got it done. He called me, he's like, oh my God, Erica, it's finally sold.
And I've got cash.
Yeah.
Yes. And so we literally just sent him an e-document and he put it in, or you can do it online, or you can do it on the phone.
Yeah, whatever.
Yeah.
Well, that's fantastic information. Well, so just so if anybody has any questions, then be sure to drop them in the comments. Let us know. We'll answer. We'll send them to Erica. We'll find out the answer for you.
Yeah.
But if anybody wants to get a hold of you, how would they get a hold of you?
There's a couple ways. So our website is infinityinvestmentstrategies.com. And then I'm on Facebook, Instagram, and what's the other one? LinkedIn.
Yeah.
I don't have a Twitter.
Yeah.
I don't.
And on Real Estate
I don't have
Divas.
And
Yeah, and on Real Estate Divas, yeah.
Divas.
So, yeah, just Erica Neal across the board. My email is Erica, E-R-I-C-A.
Okay.
My mom said that she wanted to spell it with a K, but when she had me, she was drugged up and forgot and wrote C. So that's the story behind my name. E-R-I-C-A at infinityinvestmentstrategies.com. That's my
Gotcha.
email.
Fantastic.
Yeah.
Thank you so much
Thank
for
you.
coming
We'll get that
on
in the
and like
comments.
explaining it from the ground up. We really enjoyed it.
It was a lot, but you know.
Yeah, but the energy and just the way you explained it, I feel like I have some serious clarity.
You feel better about it now?
Yeah.
I'm ready to
Good.
get started.
Yeah, right?
I'm so ready to get
I'm
started.
I'm like note to self, appointment after Thanksgiving.
I know.
Oh, yeah. Oh, yeah.
Well, I'm JER'LEIGH Thompson with Real Estate Reformation and Texel Real Estate.
And I'm Kristen Gerst with Capricorn Mortgage Investments. Send me those owner finance mortgages to buy.
Thanks for joining us. And if y'all have any questions, be sure to drop them and subscribe, like, share, all of that business.
Check the mic and make sure it sound right, boys.